Hi, Jim Kruzan here. I'm out west on a quick business trip, but I thought I'd shoot this quick video because of a lot of the events that we've seen the last couple of weeks and the incredible amount of volatility we've had with respect to the markets. In this video, we're going to talk a little bit about the geopolitical issues concerning Russia and Ukraine. We'll talk a little bit about our economy. We'll talk about energy prices. We'll touch on inflation. And then last but not least, a quick message regarding cybersecurity. So with that, let's take a closer look at the geopolitical issues and the impact it typically has on markets. This slide represents geopolitical events over the last 100 years, starting with the Great Depression in 2029, right up through COVID. On average, you'll notice a couple of things. One, the average drop because of a geopolitical event is about 5.7%. It takes about 3 weeks from the event until the bottoming. At that point, we're again down about 5.7%. It takes another 3 weeks to recover. And at that point, the market is effectively at the same place it was before the event. If we look out 3 months from the start of the event, markets are typically up about 8.5%. And if we go out a full year, markets are typically up 13%. It's important to note that a geopolitical event typically doesn't have a lasting impact on the market. While it can be scary and create a lot of short-term volatility, it rarely has a long-term impact. In fact, one would normally say that the real impact of a geopolitical event has a lot more to do with the underlying strength of the economy at the time in which the event is taking place. Let's take a look at that as well. This is a very interesting slide, and it's brought to us by our friends at ClearBridge. This is actually a recession dashboard, and it takes into consideration 12 key indicators in terms of economic strength. Things such as commodity price, wage growth, retail sales, housing permits, job sentiment, on and on. Generally, of the 12, they're ranked individually, and it's more of a stoplight analogy. Red is bad. It means a slowing economy. Yellow is marginally slowing, and then obviously green is good and go. Currently, at least through January 31st, we had 10 of the 12 flashing green. We had 1 yellow and 1 red. The consensus is green. Historically, ClearBridge has used this to help analyze and project when we should see forward-looking recessions. They have used this successfully over the last 8 recessions. When the lion's share of these components are yellow, historically, we have about 8 months before the next recession. When the lion's share are flashing red, we typically have 3 months before the next recession. Clearly, as we stand today, the economy is actually quite strong. At the end of January, it was exactly where it was in December. And as a result, we expect that the economy will be able to sustain whatever the short-term shock is in terms of global political events. I hope that helped. Another area that's in the news consistently is this issue about oil prices, currently hovering near $100 a barrel. And the worry that this could cause not only additional inflation, but eventually slow the economy down. Let's talk about that a little bit. We haven't seen $100 a barrel in quite a number of years. In fact, the last time was 2014. In fact, during the period of time from 2011 to 2014, the average price of a barrel of oil was $96. And that was for multiple years. Our economy didn't tank. In fact, the economy continued to grow, but at a somewhat moderate, slower pace. I would suggest that the impact of higher oil prices today on this economy, on the average consumer, is a bit less than it was in 2014. As an example, back in 2014, energy cost, fuel, oil, gasoline, etc., represented 3.7% of the average consumer's spend. It was 3.7 cents out of every dollar consumed. Today, that number is more like 2.5%. Part of the reason for that, we've had an incredible increase in wages over that period of time, a dramatic improvement, trillions and trillions of dollars of improved household wealth as well. Both of those have a huge impact on what impact this will have on our economy. I was talking to a colleague at our firm earlier today, and he also suggested another thing that might help is simply the fact that a lot of corporations are going to a hybrid format. So there's less commuting to and from 5 days a week. Some folks are spending several of those days working remotely, and that should also help. The last item I want to talk about as it relates to the economy is inflation. Energy cost concern is higher inflation. And we certainly do expect inflation to continue at a higher rate the next several months. But when you start looking at and polling as a consensus economist, many are expecting inflation to moderate. Many are expecting it to be much lower at the end of the year than it is currently. And there may be three reasons for that. We have somewhat of an ineffective labor force right now. We've got a huge number of people that have opted out of work. We have a huge number of folks who have left the workforce on their own accord. And the idea is, the expectation anyway, is that they will be coming back in at some point, making the work dynamic a bit more normal. And that'll help to reduce some of the inflation effective wage. The other thing is supply chain should improve as well. Today, we have many dollars chasing too few goods. That will change, that will improve the dynamics as well. And then the last thing that will also help impact inflation beyond wages and beyond supply chain is the government isn't spending nearly as many dollars anymore. We had 2 years of trillions and trillions of dollars of support. Money was sloshing all over the place and creating a number of bubbles. It was only going to get worse with the Build Back Better program. That is kind of dying a slow death. We may see bits and pieces of it coming back, but to a large degree, it won't be nearly the same size. So a lot of the spending from the last 2 years will have an opportunity to kind of run off. And as a result, there will be fewer of those dollars chasing many of these goods, all of which should improve. I'm not saying inflation is going to go back to 2% a year for a decade or more, but I certainly expect it to be hovering closer to high twos, low threes for a protracted period of time, which is still higher, but not as problematic as it's made out to be today. Before we end, just one other quick message. It has nothing to do with the economy, but it has more to do with some of the concerns regarding the Russia-Ukraine issue. And that has everything to do with cybersecurity. As the government has warned that we may see an increase in cybersecurity threat, just consider a few of these things as you go through everyday living. Get a second or third opinion via your phone on authentication issues, such as password change request, banking or wiring requests. In other words, don't just simply comply. Figure out their phone number, call back to the bank, call back to Amazon or whomever, and see if this is legit before you take any action. Use strong passwords, which include upper and lowercase letters, numbers, and symbols. Use multi-factor authentication whenever possible. And inspect email addresses closely when senders are requesting you to click on any links. I hope that helps. Stay safe. there's anything we can do for you in the future, by all means, reach out. That's what we're here for. And as always, if you have any questions, simply call us at 810-593-1624 or visit our site at kaydanwealth.com. This is Jim Kruzan. Have a great day.